Hey, this is Neil Bawa, the mad scientist of multifamily, and you're listening to the Mailbox Money Show with Bronson Hill.
All right, welcome to the Mailbox Money Show. I am so excited to be here. I've got my friend Tom Wheelwright is here to share about tax-free wealth and also the win-win wealth strategy, how you partner with the government to really be able to make things work. It was amazing to me that I was making, 250,000 a year, paying 25% or more in taxes, and then I got to when I left and I went to go real estate full time, I could make substantially less money, and it actually was more money to keep. And so that's the amazing thing about tax strategy. It's like it's like a maze. You got to know your way through it. But once you know how to get through it, it can really lead you to a much better place. And so, really enjoyed this interview with Tom. I think you're going to enjoy it. He always has something valuable to share. We talked quite a bit about the election coming up and how it's going to impact you as an investor. So I'm really excited to hear what you have to think about it. All right, welcome to the Mailbox Money Show. I have my friend today, Tom Wheelwright, author of Tax-Free Wealth and the Win-Win Wealth Strategy. I've read both books. They're awesome, and I highly recommend you pick them up. Tom, how you doing today?
Good. How are you, Bronson?
Good. I know we met through the real estate guys, one of their events, and I've just always enjoyed the way that you break things down so simply. And you've talked a lot about, tax strategy, and one thing I think that's been really fascinating to me is that in different areas of the world, no matter where you are, this is kind of just how it works, right? You want to change your tax, you got to change your facts. I remember I quote you on that sometimes.
There you go.
So anyway, why don't you give us a little bit? I'd love to just hear a little bit of your story because I know I've seen you present. A lot of people know your stuff, but how did you get to be? I mean, now you're known as like the tax strategy guy and the zero tax guy, but how did you kind of get started, or what was kind of the story of that origin for you?
Yeah. So I grew up in Salt Lake City, Utah. I got to spend 2 years learning how to get rejected in French when I was a missionary in Paris. And I so I started my career with Ernst and Young, and back when they were Ernst and Winnie, and spent 3 years in their national office. I was very got was very interested in the partnership area, which is if you're going to be interested in partnerships, you're going to end up in real estate because those two go hand in hand. Real estate people, manufacturers use corporations, and real estate people use partnerships. And so I like partnerships because they're very flexible. They have basically it's the old stupid accounting joke. What's 2 plus 2? And you ask a good accountant, they'll just say, well, what would you like it to be? And that's the way partnerships work in the tax law, right? So how should this transaction work? Well, how would you like it to work? And we can pretty much make it work however you want to. Once you understand the partnership law, you can't do that with corporations. You're gotten a lot more fixed rules, not a lot of rules. And I was the youngest of 6 kids, so never much of a fan of rules. I had a lot of rules growing up and not a big fan.
Yeah.
So I always look at, okay, well, so if there are rules, then I need to understand the rules, and I better learn to apply the rules in my favor. So, even when I remember my first, when I started at Ernst and Young in Salt Lake City, one of the managers said, so what do you think of all this? I said, well, it's a game. I said, but it's a game you can win at. So, and I was talking about the employment game at the time,
Yeah.
the
Yeah.
political employment game, right? I said, it's a game, but I look at everything that way. It's a game.
Yeah.
Taxes are a game. And it's not that you want to game them. It's not that you're trying to skirt the rules by any means. It just like a monopoly, you don't need to skirt the rules to win a monopoly. You just need to understand how monopoly works. You just need to
Yeah.
understand what the rules are and what they aren't. And that's the way it is with taxes. So that's kind of how I got started. I worked in the bookkeeping department of my dad's print shop. He had a large printing company, did really high quality printing, and so I like numbers. And then I got hooked on tax law because I love the law and I love numbers, and it's just a good combination. And then
Yeah.
of course, 20 some odd years ago, 23 years ago now, I met Robert Kiyosaki. I actually was acquired a CPA firm. He was a client.
Oh, wow.
And that was 23 years ago, 2001. So that's how long I've been working with Robert and the Rich Dad crew,
Mhm.
and traveled around the world with him. And Robert makes you think differently. I mean, that's why Rich Dad Poor Dad's still number one, right? It's still number one, and the reason is because it just changes the way you start thinking. And Robert has always challenged all of us around him to think differently. And I'd always had a different view of the tax law anyway. And I just decided, okay, well, let's look at what the tax law really is. It's not really just a way to raise revenue and a bunch of rules. It's really a way to make money and pay a lot less tax. So let's just change the framing of it so that people aren't scared of it. Because I think what keeps most people paying high taxes is they're afraid of taxes and they're afraid of the IRS. They're afraid of money. Yeah. And I figured if I could reframe it, then maybe people wouldn't be quite so afraid.
It's interesting as you talk and share. Thanks for sharing some of your story, but it does feel a little bit like there was I had one of the first regular, original Nintendos years ago in like late 80s or something. I had a Nintendo. My dad got my brother on a Nintendo. And years later, there was a thing that came out called a Game Genie, which you'd put a kind of on the front of a video game, and it would give you, it was like a cheat code where you'd be able to get in and do all these, your character could fly, or you could do all these crazy things. And I feel like with taxes, it kind of feels like that in some ways. Like there's it's, thousands of pages, the tax code is so many thousands of pages, but if you know how to navigate it, there's a way through. And it's almost like people will say, and I found this not just in taxes, but like it's sometimes from mortgage lenders, or, oh, we never do that. We can't do that or whatever. And then somebody's like, oh, we do that all the time. And I found that with CPAs that I think you kind of alluded to this. Most CPAs are like, they're very in the box. They're like, well, no, we would never want to get audited. We want to stay off the radar or whatever. But a good tax strategist or CPA will be like, we need to kind of push the envelope here a little bit to at least make sure we get what's right. We don't want to be like live out of fear. Do you find that's a lot of CPAs kind of live in that zone where they're just kind of afraid?
Well, they do. You're afraid of what you don't know. And so if you don't know the tax law, you're afraid of it. And most CPAs don't know the tax law. Frankly, they know it better than the EAs and other people who are saying that they know the tax law, and the financial planners who are promoting that they know the tax law. CPAs know it better than those guys. But there are different levels, right? Different levels of understanding. I spent 3 years with the smartest people in the tax world in the national office of Ernst & Young in Washington, D.C. I mean, these are the people who wrote the textbooks. So I have an advantage, frankly, and I'm curious. And if you're not curious, then it's hard also, because you go, okay, I'm going to follow these rules. I'm going to, A plus B plus C needs to equal D. And what I've learned over the years is I spent my life with entrepreneurs. My dad was an entrepreneur. His dad was an entrepreneur. And what I've learned is that no entrepreneur wants to know what they can't do.
Yeah.
Entrepreneurs just want to know, tell me how to do what I want to do. And so the great thing about really having the 45 years experience I have in tax is that that's not a tough question for me, right? I mean, how do I do what I want to do? Well, okay, let me understand what you want to do, and let me understand what you are willing to do. And we can do it. We can do it completely legally. I'm not a big fan of tricks and tips and loopholes. I think they're silly. They're there, but at high risk. And so I'd rather just say, well, look, let's just do what the government wants us to do it, and do it in such a way they want us to do it, and pay less tax, because that's how the law works.
You said, you want to change your tax, you got to change your facts. And in your book, The Win-Win Wealth Strategy, you talk about partnering with the government, the things that they want to do. It creates a win for them, because we know how they create housing. It becomes the project literally, and other things like that. Can you talk about some of the things that they incentivize and why they incentivize them? And because some people feel it's unfair if, hey, a physician's paying 50% or more in taxes, especially in California, versus a lot of wealthy investors I know pay zero or close to zero. So talk about those incentives a bit.
Well, so first of all, and this is actually a big part of what I'm trying to explain about this election, is that the tax law for the last 60 years has been really focused on investment and investors, and encouraging certain types of investments, whether it's manufacturing, which was the original investment tax credit that John F. Kennedy promoted, or whether it's solar and renewable energy that Joe Biden promoted. Okay. And real estate and business and everything in between. Understand that those are all a promotion of, we want you to invest your money a certain way. So it's really not how you make your money, but what are you going to do with your money? And that's the key question, is what are you going to do with your money? And that's actually a question I find that most people don't know the answer to.
Yeah.
It's a little scary to me. I'm going, okay, so you don't know what you're going to do with money. Well, yeah, I'm going to put it back in my business. Okay, great. Well, you're going to there's tons of tax incentives in business, of course. That's the number one incentive. But what about the money you're not going to put back in your business? Well, I'm going to save it. Okay, well, you're going to pay tax on it because you save it. I might spend it. Okay, you're going to pay tax on it when you spend it. But the tax law right now is very much heavily geared towards taxing consumers and rewarding investors, particularly investors in business, real estate, technology, energy, and agriculture. Okay. What's interesting is in this presidential election year is that you have two sides that are on polar opposites, and they're polar extremes.
Yeah.
You have Trump, who is very much out there to punish the consumer through tariffs.
Mhm.
That's absolutely a punishment of consumption.
Mm.
You are punishing consumption, and he wants to heavily reward investors, through depreciation tax benefits, credits, other tax benefits. And then you have the Harris-Walz team that they want to punish the investors very heavily, and they want to reward the consumers, and they want to actually get more money to the consumers. And so if you're a consumer, you're thinking, well, I'm better off with Harris-Walz. If I'm an investor, I'm better off with Trump-Vance. But even that's not that clear, because let's say you're a consumer, are you truly better off in the long run if you have high inflation, which is caused by too much consumer spending, right? And you're taking money out of the investment community and putting it into consumption. Anywhere from $5 to $8 trillion is the most recent report on the Harris-Walz proposals. Well, you put $8 trillion into the economy that wasn't there because it was in investment. Okay. How does that not cause inflation? I've had conversations on my podcast, The WealthAbility Show, about this exact thing. And the reaction I get from every economist I talk to is, yeah, causes inflation. Well, if you get the money now, but then you pay inflation later, are you better off? And then on the investor side, you go, okay, well, wait a minute, you're going to tax me high now. Yeah, but where are those people going to spend the money? They're going to spend the money on your business. So you're going to get the money back. So are you really that much worse off if you get taxed now and then the consumers have more money to spend on your goods and services? It's like during the pandemic, right? You had all this money come out and people spent it. Where'd they spend it? Amazon, Walmart, right? And it went right back to the rich people. So, it's on the surface, it's very clear that you've got one camp that wants to punish consumers and reward investors, and the other camp that wants to punish investors and reward consumers. But I don't know in the end that it actually plays out quite the way the media would, or the two sides would have us believe.
Yeah, exactly. I think it's been a bit of a circus this year, and it's hard. Everything has a cause and effect, and there's a lot of different ramifications. I was going to ask you. I know that there was the Trump tax depreciation. Is now at 60% this year. Goes to 40% next year. There's some talk that if Trump gets reelected, that may come back and be back to 100%. Obviously, that would help. For investment in real estate or other types of things that have depreciation. Do you have any opinions on that? If it is Trump or it's Harris?
I think if Trump wins and the Republicans control either the House or the Senate or both, that will get bonus depreciation back. If the Democrats win and they sweep the presidency, the House, and the Senate, we won't get it back. If they don't sweep, we still have a chance of getting it back. Okay. So it's, the down ticket I don't think there's a year where it's been more important to pay attention to the Senate and the House races as this year, because they'll have a huge impact. And if you look at, for example, Biden's term in office, he would never have been able to pass the Inflation Reduction Act, which was his big tax bill,
Right.
if he hadn't had the House and the Senate in his camp. Right, he would never pass that with Republicans, because the Republicans were uniformly opposed to it. Whereas Trump would never have passed 2017 Act if he hadn't had both the House and the Senate. So what we do know is, Bronson, is we are going to get major tax legislation next year, because, as you alluded to, the 2017 law phases out. And it starts to phase out in 2025 and fully phases out in 2026. Mm-hmm. So that means that between 2025 and 2026, no matter who's running the show, we're going to have major tax legislation. Think of it this way: even if they do nothing, there's major tax changes. So because the law lapses, right? It's like back in 2010 when the Bush tax bill ran out. Right. So they had to have some new tax legislation. Something had to change, and it could either just expire or some of it could be renewed. And that's what happened in 2010. Is some of it expired and some of it renewed. We actually ended up with a bigger estate tax exclusion under Obama than we'd ever had under Bush, which, well, not than we'd ever had, but than we'd typically had before. So it's going to be an interesting, I would definitely pay attention to what's coming in the tax law, because there's things you can do to plan for it. There's things that you ought to be doing this year. And there's definite changes that you might have to make in the next 2 years.
Yeah, it is interesting to see, and that's what's interesting about our government, is that, a lot of times, no matter who's president, if they don't control both the House and the Senate, it's harder to pass certain things, or it can be kind of we've seen that with certain presidents that just can't pass anything because they don't control one or either, or both. And so I guess, what are some of those behaviors that, this year, kind of going into the election at the end of the year, what are some things that you think generally people should look at in regards to what you shared, that things can be changing with the tax?
Well, I'd say first thing is if you have a net worth, if you're single and you have a net worth over $6 million, you better be doing estate planning. If you're married and you have a net worth over 12 million, you ought to be doing estate planning this year, because next year the estate planning attorneys are going to be too busy. You're not going to be able to get it done. You don't have to sign it until after the election, but you need to do it. Okay. So I'm encouraging everybody to talk to their estate planner, talk to an estate planning attorney along with their CPA, because before too long. Actually, I'd be talking to them this month. Yeah. I'd be talking to them right away, because I just think they're going to get too busy. I've got a lot of buddies that are estate planners, and they're already just swamped. And they're telling me, go next year, you're not going to get the time of day from an estate planner.
Yeah. Yeah, that's really, it makes sense. So yeah, with the changes coming, to have, that would be just like talking, making a plan. I know, because if you don't,
well, it's setting up trusts. It's gifting assets. It's changing the title of your assets. There's actually a lot of details that you have to do. And the hardest part is making the decisions. So like you're talking about, okay, so look at you. You're young, you got kids, and you're going, okay, your daughter, and how old is she?
She's 11.
She's 11. Okay.
Yeah.
When you die, she could be 12 or she could be 60.
Yeah.
You don't know.
Yeah.
But you're going to have to set up estate planning that accommodates either one of those.
Yeah.
And that makes it really tough. Plus, if you have an ex-spouse, you have to have conversations with the ex-spouse about that estate planning, because what you do affects your common children, right? So I think the decision I found in my career, that just the decision-making process is so difficult for people when it's so unknown when it's going to happen and what things are going to be like in the future. And on top of that, your point of view will change. I mean, I guarantee you, you get into your 60s, your point of view is different than it was in your 30s.
I'm sure.
Okay.
Yeah.
There's no question about it. And so you have to build in some, to the extent you can, you have to build in some flexibility into that estate planning. So it's a very long-term, it's very hard for people to do that kind of a long-range plan unless they just absolutely, well, I want everything going to my kids. Most people don't. Most people are worried about their kids getting spoiled and not having to work and, just, sitting around playing games all day and not, they worry about that. And so I think it's just one of those things where it's a good time to have a conversation, because I do think, for example, I think the estate, unless the Republicans sweep, I think the estate exclusion is going to change.
Right.
I think it absolutely will go down.
Depending on where you live, it will change where you live. It will have a different impact depending on where you live.
To some extent, mostly not. Mostly it just is dependent on how much wealth you have now and how much wealth you're going to have in the future.
I see.
So if you're building wealth, you'd really, you don't want that to go. Nobody wants their money going to the government. Right. I've never met one person, even the most liberal Democrat, that wanted their money going to the government. Okay. So
they want somebody else's money going to the government.
It's okay if somebody else's money goes to government. They don't want their money going to the government. Nobody wants to pay higher taxes than they're required to. And, and on top of that, so the estate tax doesn't produce a lot of revenue for the government, but the optics are so important that, hey, we're not letting the wealthy pass on and create generations and generations of ultra wealthy. And so so you just need to be planning for that. That's just one thing that you have to plan for. The other thing is I do think you have to plan, like, let's say you're a real estate investor like you are. You ought to be looking at, okay, well, what happens if we do get bonus depreciation? What happens if we don't get bonus depreciation? If we do get high inflation, will that mean we're going to have higher interest rates? Because that's how the Fed deals with inflation, right? Is higher interest rates. If we have higher interest rates, how does that affect my real estate? How does it affect what kind of loans I get on my real estate? I mean, actually, all these things work together, and you can't ignore any one of them when you're making decisions, and tax is going to impact all of it.
Yeah, absolutely. Now, you brought up a number of things. Like you said, states don't want to have this generational ultra wealthy. The funny thing is there's this class warfare, but in a study by Fidelity Investments in 2019, it said 86% of millionaires are self-made. So there's actually, most people actually kind of figured out on their own. I was curious from you, I know right now, there is some deductions through multifamily real estate, obviously it's 60%. So we're seeing usually 30 to 50% deduction where it was 100%, you get you get the full amount a few years ago. Oil and gas is Greg, we're seeing sometimes, of active income, 80, 85% in some investments. What are some other asset classes that I guess you've seen that, people are getting into that do offer some tax incentives right now?
Well, energy is the biggest,
energy.
Right? And it doesn't matter whether it's fossil fuels or renewables. Renewables actually have bigger tax benefits than fossil fuels to some extent, but the big caveat there is, so the credits that come with renewables are available to anybody, but the deductions are only available if you have passive income.
Oh, wow.
In most cases. Okay. Not if it's your own building, but in most cases. Whereas with fossil fuel, the deductions are available to everybody, no matter where you are. Yeah. So there are some subtle differences that you need to sit down and run the numbers with your CPA. There are subtle differences there. So energy is a big one. Real estate, obviously. Business is the biggest. And then agriculture. I see more and more people getting involved in agriculture. First of all, the tax benefits are way bigger than probably everything else combined, because they get better real estate benefits for their real estate. They get better business benefits for their business expenses. And they just have, I've never met a successful farmer or rancher that paid much in tax.
Yeah. That's amazing.
They just don't. It's just the way the tax law is built. And you think about, why is that? Well, because food and shelter, those are the two most basic needs. And so we better be producing those, right? If nothing else, we better produce food and shelter. And that's why real estate and agriculture. And then of course, the third thing is energy. You can't, the country runs on energy. So those three, those would be the big three. Obviously, there are some other ones. I mean, there's some subtle ones like insurance, which it can be tremendous. There's some, of course, then there's, how do you actually structure your business? How do you, all the details, they can be little amounts that add up quickly. And, that's how you get to tax-free wealth is you just pay attention to not just chapter 1 or chapter 2 or chapter 5 or chapter 10, but you pay attention on all 24 chapters.
I've noticed too, we have a group called the Wealth Forum, which is for high net worth investors that are, typically 2 to 10 million net worth or more. And it's like, when people are under 2 million, it's kind of like, I'm looking for a deal, maybe a little bit of tax stuff, whatever. But you get the higher net worth, it's like advanced strategies and business and legacy and family office and allocations and different things. And it's a different set of tools. And that's what's really great. I'm imagining for deal flow for some of these, when it comes to especially renewables, there's a ton of oil and gas deals out there, but carbon credits, those exchanges for that, kind of the agricultural stuff and some of these things. What do you find people find access to these type of, or do they actually just create them themselves through some sort of tax strategy firm?
Well, I think most of them are finding them either through some type of either a mastermind group like yours, right? Their CPA, or their financial advisor. I mean, that's pretty much where they're getting them. I don't think they're getting from their attorneys. I don't think if they're smart, they're not finding them online, because that's a terrible place to find an investment or any kind of advice. It's the worst advice in the world. Is anything online, you got to take with a grain of salt. By the way, including anything I put out in social media, take it with a grain of salt, because it's just general education. It's not specific advice to your situation. Right. And I think we get, I was at a real estate conference recently where one of the sponsors was a scam. It was an absolute scam. Wow. And I told the promoter of the event, I said, just so you know, that's a scam. I mean, it's a scam that the IRS is trying to shut down, and it is a true scam. And he goes, really? I said, yeah. I'm going, it's actually downright fraud. In my opinion, it was fraudulent. And, this kind of stuff is just so prevalent all over the place. And so that's why I say, you got to be careful. I mean, who's on your team, right? You got to be careful who's on your team.
Well, it's hard. I actually would love to get to this. We've had a deal that I'm an investor in, and it's been, over 10 years. It's a business type investment, paying consistently every, just really consistent every quarter. And then suddenly something changed, and all of a sudden they haven't. So, and there's been tons of diligence done on this group and on this thing over the time, and, hundreds of millions of dollars involved. And we're just a, very small part that I invested personally in. But I mean, how do you, that's the challenge, is like, when we look at, like I'm going to vet a farm, I'm going to vet an oil and gas operator, I'm going to vet, how would you, as an investor, is it worth hiring somebody? I guess depending on how much you're putting into it, but what's the level where you actually hire somebody to do due diligence for you? Or, I guess the diligence piece is tricky.
Well, here's the thing. I mean, I think you absolutely should have somebody on your team that does due diligence. And in many cases, it should not be you. I mean, I will tell you, I am not the person you want doing the due diligence for you. I'm not that detailed. I'm really good at identifying a strategy. I'm really good at identifying, how something works and kind of walking you through it. But I'm not the one to do the due diligence. So there are people that have a natural instinct for due diligence. We call them fact finders, high fact finders, where they're going to get into all the little details. That's awesome. Those same people, it takes them 4 years to buy a car. So don't have them buy your car for you. But it's when it comes to investing, the other thing is I think you ought to make a single decision and then just repeat that decision over and over again. I think that's what a professional investor does. I think that is the number one difference between professional and amateur investors. Professional investors, even you look at a Warren Buffett, you look at his decisions, they are so consistent. And the only time he loses money is when he goes off of his strategy. That's when he loses money, is when he, and every once in a while you'll see it, which is, makes me feel better about myself. But, because normally he's making billions of dollars, and, but he's very consistent. And that's true with all really good investors. I've been traveling with Ken McElroy, who, for years and years and years. We've been on stage together all over the world. And I'm going, what one day I sat down with him. I said, so let me see if I get your strategy right. And I kind of walked through all of his criteria for investing. He goes, yeah, that's exactly right. I'm going, and you just do that over and over again. He says, yeah. I said, okay. I mean, that is the key. That's why he's such a successful investor and developer, is that he does the same thing over and over again. Mm-hmm. If you see a hedge, the people who kind of fall out on this, you see a lot of it with hedge funds, is that they will do something, but then they'll get more and more aggressive, or then they'll go, they'll get shiny object syndrome, where they'll go chase something else because it looks like it has such good high returns. It'd be like, I know an oil and gas guy who started chasing real estate. I'm going, stop, don't chase real estate. And I had a real estate guy who wanted to talk about oil and gas. I said, why would you talk about oil and gas? You're a real estate, have spent your whole life in real estate. Why would you ever try to understand something as complex as oil and gas, and so easy to be defrauded? By the way, you want the easiest place to get defrauded? That would be oil and gas.
Yeah.
I've been involved in the oil and gas industry for 45 years. And I will tell you, there are a lot of charlatans out there. There are a lot of people that, and then they'll just tell you it was a dry hole. Because, how do you know? Right. Yeah. When what they really did was just run off with your money. Right. So, you have to do due diligence on the deal, but you also need to do due diligence on the team.
Yeah.
And you'd better understand the investment yourself. Because I always tell people, if you don't understand it, get somebody to explain it to you that's a professional in that area. And if they don't understand it, run. Just run. I mean, I had a client, and I don't want to take too much time on this, but I had a client that brought me tax. He was all excited about this tax deal, and he brought it to me, and I said, well, let me talk to this attorney that's presenting this to you. So I talked to the attorney. I'm going, so help me understand. This is what this says, but you're saying it says something different than what it says. And we're like on the phone for 10 minutes, and the client shut it off. He goes, clearly this guy doesn't know what he's talking about. And I'm going, he goes, I couldn't understand it. And so I brought it to you. And he goes, if you're going, look, this doesn't make any sense, then you probably ought to run. I mean, I'm sure you've seen deals in real estate, energy, where the promoter could not explain, why does this work the way it does? I was listening to a video on life insurance today, and I'm going, this doesn't make any sense to me. I'm going, now, doesn't mean it doesn't make sense. It means it doesn't make sense to me. And my point is, until it makes sense to you, don't invest in it.
Yeah, exactly. I mean, Buffett is the example you brought up, and I follow Buffett a lot, and he says, we don't invest in anything we don't understand. And he's, for years, didn't do technology or other investments. He's like, and this is one of the smartest guys in investing, one of the smartest guys in the world. And so I think, being able to understand what you invest in is super important. Well, Tom, I really appreciate you coming on today. I mean, you have so much to share. I encourage everybody to check out both your books. You're always putting so much value out there. And I've just so appreciated the interactions we've had, as well as the times I've heard you speak. And so I just encourage people to reach out to you. And you have a tax strategy group or referral. I'd love to have you talk about that. Any way people can reach out or connect with you.
Yeah. So we actually have started the first CPA-based tax advisory franchise in the United States, called TFW Advisors, as in tax-free wealth advisors. But it's tfwadvisors.us, and we have franchisees around the country. And we're happy to talk to you, whether you're interested in an advisor or whether you're interested in owning a franchise.
Awesome. Okay, great. Well, we'll put some links in the show notes there and below. So thanks for being here, Tom. Just really appreciate all the value you're adding. And I know, people that are in education like this, it's not because, there's not other things you could be doing or easier things, but you really like giving back to folks. I really want to value for that. But thank you for being here today. And I really appreciate your time.
Happy to do it.
All right, great interview with Tom. Again, super valuable. The part I really enjoyed a lot of it, but the part about really getting deal flow, getting a tax strategist involved. We actually are connected with a tax strategist that we're really excited about working with and referring people to. So if you need a tax strategist, obviously you can reach out to Tom. We also have one that we're working with as well. And whoever you reach out to, it's just great to have someone who is not just a CPA. Everybody thinks, oh, I've got a tax person, I've got an EA, I've got somebody who does my taxes. Well, a tax strategist is a different, it's a whole different genre. It's somebody who's actually, doing this. So we encourage you to reach out to Tom, reach out to us. We'll connect you with someone that can help you and really help you get where you want to go. And just as Tom said, it's like, well, where do you want to go? We can create something to help you get where you want to go. So it's important to think about if you're selling a business. We're in the process of buying a business. So that would be something that to think about. Hey, we're actually having a meeting with a tax strategist to talk through, we're buying this business. What should we be doing right now as we're buying this business, right? So if you don't plan, those who fail to plan are planning to fail. So encourage you to plan, go for it. You can reach out to us for that, and look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to BronsonEquity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.